I'm back with Happy Investor, with this time 5 of the best companies to invest in to achieve financial freedom. Yes, financially free thanks to good investments in great companies. That's the essence of this video. That's what we're going to talk about in this monthly update. Every month we select 5 of the highest quality companies that can make us financially free, and we share that on our channel. So make sure to subscribe if you want to stay updated on the new findings we have. And this time in this edition, high quality companies to achieve financial freedom. The main criterion is that the company has a sustainable competitive advantage in combination with strong management that, in the long run, combined with a solid earning model, ultimately leads to a higher profit margin. Companies that consistently achieve a higher profit margin than, for example, their competitors. They just keep growing faster over time. They have more capital to reinvest, and simply put, they either crush the competition or they swallow it up. Because the winner takes all in the laws of economics. That's why you want to invest for the very long term in the best companies. Not only have we selected these companies based on quality, but we also look at the short term because we also want to beat the S&P 500 in the short term. So that's actually a double profit factor to slightly increase your earnings. We do that with, for example, a number of tools that I'll show you, but that doesn't guarantee success. The strong competitive advantage leads to another benefit, namely the peace. How do you start investing? Because often these high quality companies are highly valued, and that's the difficult part. Often you pay a premium. In other words, you pay a premium for quality, but that also brings some uncertainty for the future. If they can't meet expectations and you've paid too high a price, yes, that's the downside of quality investing according to the teachings of Warren Buffett and Charlie Munger. And a lot of people do this. So there are only a few great companies, and of course they keep getting a higher price each time because more and more people want to buy that. So it's really difficult to handle that well. But a much simpler way to trade with that, is it about buying a little more monthly or periodically? And my personal preference is about only select a company that you truly believe in 100%. With a strong earning model, buy it every time it drops by at least 20% or even more than that. Because then you automatically buy at a 20% discount. Our number that is currently undervalued is, but in the long run, it levels out and you have high potential returns with great companies. You need to make sure that they are really good companies that align with your long-term strategy. That's why it's purely for inspiration. That is, as you know, so always do your own research and think carefully about what you invest in. Invest only in what you understand. We start with Nestle. Not so much because this is the most amazing company for this selection, but also from all the opportunities you have regarding great companies to invest in. But Nestle seems to be a unique buy-the-dip opportunity after a very long period of declines. So it has an interesting combination of relatively good exportable valuation, exportable growth, a bit of dividend too, so possibly also long-term growth. It's, of course, just a strong company. From Morningstar, we even get a 5-star rating. They indicate that the economic moat, or the competitive advantage, is strong and broad. And their price estimate is the intrinsic value of 100 CHF, and here the price is 77. It means possible undervaluation. Analysts think it's a buy with a price target of 88 as the average. And the downside potential seems relatively low, so that might still be the most important thing. Not that the upside potential seems very huge, but after a very long decline, where the valuation had indeed risen relatively high, has the valuation become a bit more attractive now? And you can also see that based on historical valuation, that for the first time in a long time is the price is below the blue line. And the blue line represents the normal multiple that the market is willing to pay. That's the price according to Morningstar. And we can also evaluate that, for example, evaluating cash flow. And then we actually see that for the first time in a long time, that even based on price to cash flow is below the fair value line. That's the orange line, which basically indicates the intrinsic value based on price to cash flow is equal to 15. What does all this mean? Well, if we look at a bit of forecasting, at least for the medium term up to the end of 2027, that price to earnings has decreased and to a level of around 16/18. Normally, the market is willing to pay a multiple for Nestle of, let's say, based on 20 years. Dwayne, the price of Unix has dropped to 16. We see the profit growth expectations below. That's not super high. But because the valuation is relatively on the lower side, they don't need a lot of profit growth to still achieve an attractive return. In this case, 13.6%. And I believe this is a better outlook than, for example, the S&P 500 at this specific moment. If you're going to use a lower multiple, then of course the average return is also lower. What of course isn't included yet is that possibly the company, if the weather performs better, it can also achieve faster profit growth. It can of course go the other way, so it's all just an estimate. So don't just focus blindly on the numbers. The upside potential just seems to simply be in our favor for this stock. Nestle is currently relatively well valued compared to the sector median. Here we see slightly higher estimates in this database model. Also, when we look at the price to cash flow, that aligns. And don't forget, they also pay out dividends, almost 4% even at this price level. Well, something to keep in mind is the total debt, relatively a lot of debt. So also pay close attention to the balance between short and long-term debt. Well, what you also want is, of course, investing in quality. This is about strong companies for the long term that can make us financially free. And in this case, it's the own dividend share. Also, what's important is, of course, to look at the profit margin. Well, despite setbacks, Nestle still maintains a good, healthy profit margin, and that return on equity is still remarkably high. Well, and that's not just the case now, but the 5-year average is and remains high, especially for such a relatively large company. So they're just simply doing well. Return on total capital is also above 10%. And yes, I think Nestle is currently available at an interesting price. That valuation or price has actually dropped to a level equal to 2015. Actually, since the all-time high, but let's take a slightly lower price. The price level has dropped by about 35%, so that's quite a significant drop. And in the very short term, we do see a rebound in the stock. This seems like a lot, but it's only 5% in percentage. It might start to drop a bit again and stabilize around this price level of 74%. That could really be a very nice entry point. Or if you can't wait, I would just go ahead and take a small position now. But only if it fits within your risk profile, your strategy, and that you've done your own research. Well, I think this also seems like a great long-term investment. But in the very short term, we can at least see that momentum is increasing on a weekly basis. And the MACD is starting to cross. The stochastics are also starting to cross, and the price is almost starting to rise above the 1.20 mark, the red line. Not that all of this is relevant, this is pure technical analysis, and that's the last thing you want to look at. Let's take a look. It's very important to take a look at the fundamental valuation, and that seems to be quite attractive for Nestle at the moment. So at far, one of the most interesting, strong companies right now, I think, where you can actually pay a fair price for high quality, while many other companies in the US market or globally are quite high priced. In terms of price, the second really interesting company for high quality and long-term investing to achieve financial freedom is Sale Capital Group. And I'm actually so enthusiastic that I might even take a position in this company. It fits well within the current portfolio that I have. Namely, I don't have a company that deals with insurance yet. And as you know, insurance is super interesting. Earning model, Warren Buffett has built an entire career on it and has become one of the richest people in the world. Of course, he does a lot more with Berkshire Hathaway. But Warren Buffett, yes, of course, great investment, investor and entrepreneur. And he also saw the potential of insurance. Now, Kingsale Capital Group is very interesting and has a few, I think, high quality factors that you definitely want to think about and research yourself. But they have a specific focus as an investment insurance company. Having a focus is always very good to become a leader in a specific niche, and what can lead to a greater advantage for a larger market. Also positive, the founder is still at the helm, and I always find that an important criterion, and other members seem to be experienced enough. Results are much more important. Well, past results are no guarantee for the future. Everyone knows it, the little saying, but often it is a precursor to continuous outperformance in the long term, because they perform well for a reason, and we see here that the compound annual gain is particularly high for this company. Particularly high, 50% versus the S&P 500. They are proud of it, and they should rightly show that, well, they have an exclusive focus on the market, and And for that, you need to study carefully what it all entails. But there's a lot of interesting data that you can find in the investor constellation. Looking at the Morningstar fair value estimate, it's slightly higher than the current price. And we will see that this company is also very interesting as a kind of continuous buying based on declines. But I'll talk more about that in a moment. The economic moat, according to Morningstar, is strong, broad. So it means the star brings that advantage. I already mentioned it. They have a specific focus. So niche leader, an analyst. There are 13 of them. Overall, we also expect a slightly higher price in the short term, but it's mainly a long-term compounder. As you can see, long-term, at this moment, it seems that the price Morningstar, that seems relatively on the higher side with a price-to-earnings ratio of around 25. That is indeed below the historical fair value line. But in this case, that's not the case. Price to earnings equal to 15, but equal to 30. So the market still expects quite a bit from this company. They expect high growth. But we're looking at the normal multiple that people are willing to pay. That's actually quite high. 5-year average. We definitely want to have that lower. But I think that 30 is quite high price to earnings to go from. So let's stick with 25. The current valuation is at a price to earnings ratio of 27. Below we see analysts, they expect an earnings growth per share, so an EPS of about 14%. Yes, then you should actually stick with a price to earnings ratio of 15%. That's not even on the screen, so we wouldn't be realizing much return. However, the market is willing to pay a higher multiple, for example, 25%. Then from this price level, it could achieve an average return of about 12%. The only reason I'm still a bit hesitant to take a position is because the price for a Unix of 25 is not on the low side. Quality, yes, but not on the low side. It's that simple. So maybe, if you're lucky, a better instant moment might come up, but that's the downside. It could also very well be that the price never drops below the current level. So the price for a Unix is relatively a bit higher, as you can see. Also in the data model, what we have here in front of us. And by the way, if you want to access the discounts on all the programs we use or all our own products, then take a look at the links in the description of our YouTube channel. You'll also find affiliate links from partners we trust. Do you often get such a discount yourself? We also get a share of the profits, so that's pure win-win, costs you absolutely nothing. Extras. In addition, we also give away free downloads, a free ETF book that explains the ins and outs, how you can invest in ETFs, and even more downloads like a calculator tool that I've been using for my own financial planning for years. Nice, handy, and you'll definitely benefit from it. And it's free. The bad luck ratio is a bit on the high side according to the data model, namely 1.8, but the price to cash flow is low again. We've only looked at the price to earnings so far. If we really look at the operating cash flow, we see a different story. That price to cash flow is relatively lower, around 11, 10. And would that stay around 12 for the next 2 years? In terms of growth, you have an average return of about 20% per year. So there does seem to be some upside potential. Moreover, the market, the valuation of the company is only 10 billion. But let's say they could grow to, for example, 50 billion or maybe even 100 billion. That still means it's small enough to be interesting. Yes, to be able to offer growth potential. It's already very interesting, but it gets even more interesting. So we know, on one hand, that the price might be a bit on the high side. Maybe a better entry point will arise. Who can say? Just look at the beautiful numbers regarding profit, and especially the return on equity that they create right now, even above 30%. Better than, for example, Topicus, which we will talk about shortly. Special high return on total capital. 5 years along the way, even 17%. Yes, very interesting. Well, even more interesting. I've already talked about it. Best companies, strong. Point is that advantage coming. You want to keep proving that even when they drop. And this stock drops quite a bit. Well, a lot. Minus 23%. And then we see a significant price drop here, probably in response to the quarterly figures, means was 25%. And recently it has also dropped again by about minus 20%. But our long-term algorithm gives a buy signal based on a crossover long-term. And you can also see that it just keeps rising in the very long term. Only The last big drop was about minus 33%. And even during the corona crisis, it might have been even less. Can't see it very well. But yes, also minus 30%. So a few moments, 1, 2, 3, 4 moments when you could have bought in for about minus 30 to minus 25%. And since then, the price has only gone up. So it's very interesting, as well as DCA, which stands for dollar cost averaging, or every time. That's on Mondays, but you can also buy periodically, just purely based on price drops. Very interesting company. Note, this is not a buy recommendation, but I find it an interesting company. I've been following it for a while. I might even do that too. But just one step. If that's the case, I give an update on my own investment portfolio every month. Completely free and for nothing. With recent stocks that we buy and sell, and an update on the market. So definitely subscribe and also give a like to the video. That helps us grow in terms of the channel. And of course, only do that if you want to stay updated and if you appreciate our videos and that this content helps you. By the way, feedback is always welcome. We love to learn. Topicus is a spin-off from Constellation Software, a very well-known company, of course, for acquisitions of vertical martins, software companies. A very interesting strategy. And Constellation Software has also shown how successful they really are. Now, Topicus is a relatively smaller spin-off that focuses on exactly the same strategy, but then in Europe. So very interesting, and the market value is still around $500 million, so not too big to grow, for example, by a factor of 10. That could very well be. Constellation Software already has it. Almost done. Be sure to check out the Investor Constellation page. Do your own research, but really understand what this business model is. It can be very interesting for the long term. The Morningstar rating is, however, 2 stars. We indicate, yes, in our opinion, the intrinsic value is indeed quite a bit lower than the current price, namely about 30% lower. So that could be a signal that we need to be a bit cautious with this stock. Market analysts give a price target of 124, but that's just one. There is very little coverage of this stock, and it's also a bit tricky to value this stock properly because the earnings per share look really bad, namely a price to earnings ratio of 60, and another database even indicates that it's 90, so a little bit higher. But here you need to look at the business model, and this business model mainly works on, for example, the cash flow. And unfortunately, in these tools that we use, there isn't not a good standard to show how it works. One thing we can look at, for example, is the price to EBITDA, and that's another factor you want to know about serial acquirers like Topicus. The price to EBITDA right now is relatively good. Well, high. Has it also been high in the last 5 years? It all seems a bit on the high side. If we look at the historical CAGR for operating cash flow, then we see that the current price to cash flow is indeed on the higher side. You could achieve a high return if it stays very high, but because all the prices have risen so high, it's no different for Topicus. The risk at this moment is just a bit higher, so it could very well be. So that has been the case for a longer time, that a better opportunity arises here to buy. Don't forget, the selection of the best companies is based on high quality. Topicus is a seriously good company with an interesting high quality business model, and they also have a positive advantage, which just keeps getting bigger. So you do want to pay a higher price. But the question is how much. It's very difficult to value this company properly. Personally, I choose to look at the cash flow. That is in line with the 5-year average, but that cash flow can always be lower. We also see that in 2021, the price was relatively high. Actually, just as high as today. It's very interesting what happens when the application costs always break through, but keep an eye on that. In a shorter time, the share had dropped by about 50%, and regular declines of about 20% do occur. If Topicus were to drop more often, I think there could be good entry points, or simply with the dip strategy based on periodic payments, and that prevents you a bit from having too much trouble valuing it. Because to be completely honest, I don't really know either what would be an attractive valuation for Topicus. A lot more research is needed for that. I've only been following the company for about 2 years, so that's a bit too short for me personally. What you really need to consider is why it's such an interesting company. It's because it's an asset light. The business model is, that's why Constellation Software is the founder of that, or one of the founders of that. That also shows it on the stock market. And I'll briefly explain what it means. Well, the net income translates into that price to earnings ratio we see here, which seems relatively very low. But what happens They also have relatively many investments. So in the end, it all comes down to cash flow because those investments or the net profit, that is excluding depreciation, because they invest a lot. They also write off quite a lot. And that duplication, that's the depreciation. So you can add that to it. So what you want to look at is the operational cash flow. Then you see that because you add a few things together in the net profit, that the cash flow is indeed a bit higher, namely with a factor of almost 4 times or 5 times. That's quite high. Now that cash flow from Constellation, that's the most important metric for Topicus, that it keeps rising. And you can also see that that is still increasing. So that's really good. An asset-light business model means that you have cash flow growth, but that you need relatively little new money to keep stimulating that growth. So, non-asset-light business models are, for example, large factories or oil companies. They have to continuously invest a lot of billions or millions in new factories and new machines. But that's not the case with Topicus because you build software once and can roll it out very scalably. So that capital expenditure is very low. So you get the free cash flow by subtracting the cash flow from operations from the capex investment. And that capex investment is very low. So that's really good. Sign of an asset-light business model. That means they are simply generating more and more money. You also see the cash flow from acquisitions. That's, of course, the money they continuously reinvest in acquisitions. On Topicus's website, you regularly see news about the shares they've bought. So definitely take a look at that. Overall, very interesting. However, determining the valuation is quite difficult. One thing you definitely want to know is look at the quality. It's the performance on return on common equity and also the return on total capital. From Topicus, it's relatively strong, but especially the return on equity. That's why I'm a big proponent of investing in serial acquirers, because they are able to achieve relatively high profitability on their own equity, and especially when it comes to software companies, given the low capex. So keep that in mind. In the short term, it can still be very volatile. Every drop of about 15 to 20%, I think that would be a nice buy the dip opportunity. And yes, it could be that this is the highest level in a while and that it will start to fall again. But if you consistently buy more every time, in the long run, Topicus will definitely become more valuable. It's just that we might need some patience given the current valuations. Since our last analysis of PayPal, it has risen by about 20% in return, but it definitely still has a lot of upside potential, even for the long term. So PayPal definitely fits our definition of VAN. Best companies to invest in for financial freedom. Now, in the short term, the price target is set at 95, and according to Morningstar's analysis, the fair value is around 105. Does that mean PayPal is still somewhat undervalued compared to its intrinsic value? And if we look at the historical valuation, we mentioned PayPal earlier when it was at a much lower attractive price, and in the meantime, it has gone up a bit, only based on historical valuations. Does it still seem a bit below the normal multiple to learn? But what does that mean? If you maintain a price-earnings ratio of 15, and we see that the current price-earnings ratio has risen to about 20, and here we see the analysts' estimates of profit growth, and there are quite a few of them, so it doesn't make sense that you could make better profit estimates than this bundle here. That might be the case if, for example, only 1 or 2 analysts provide coverage, but here the market might actually be efficient for PayPal. In the somewhat longer term, and then you would maintain a price-earnings ratio of 15 or 16, and that doesn't really mean much upside potential. However, if you maintain a normal multiple of 30, the average return could rise to about 30% per year, and the total return is significant. Turn to 100% return. Well, I think that's a bit on the high side. But if you maintain the scenario of a price multiple with earnings of 19, PayPal could still achieve an average return of around 10%. Achieve doesn't sound superior, but of course it's about the long-term compounding. And for that, you also need to look at the piece, the high quality that it offers. Now, because the valuation has increased in the short term due to the strong price rise, it has become a bit less attractive. Certainly compared to the sector median, but PayPal is definitely a strong company. Maybe not the absolute best company, but definitely a strong company. And the bad luck ratio, that's obviously important, corrected by the growth, which is at 1.6. Well, that's not super good. Actually, you'd prefer it to be below 1, and there are plenty of opportunities below 1, but Often you pay, as I've already pointed out, a premium, an extra cost for higher quality. It could very well be that in the short term, PayPal drops a bit for a slightly more attractive entry point, but the price to cash flow is still relatively favorable compared to the sector median, and it's also well below PayPal's 5-year average. That has certainly been significantly reduced since the fall of 2021. Profitability is what it's all about when you're talking about strong companies that have a solid position. In other words, a sustainable competitive advantage, and they want to keep expanding. The crucial thing is that they continue to generate higher profits. What's striking is that compared to the sector median, the profit margin is relatively low. On the other hand, at this moment anyway, that's why PayPal gets a strong buy. In factor analysis, the return on equity is quite high at around 22%, and the 5-year average is also high. So PayPal is definitely doing well. Good business regarding, yes, from return on equity. And they achieve high returns on their capital, so that's positive, especially as a long-term investment catalyst. In the short term, PayPal has risen significantly, since we've mentioned it a few times, but that was more because the valuation was simply more favorable around this time. Look, even a PayPal can be significantly reduced. Since 2021, the decline has been very long. In the middle of 2 years, it has dropped by 30%. So be careful with what you do and just buy great companies when they're especially not overvalued. Now, PayPal might be a bit higher. It can now be a bit tricky in the short term regarding the price tag, but in the long term, PayPal still seems to be an interesting company that could make us financially free. I analyze daily, I have a ton of stocks, and I also use all kinds of tools and screeners. And for example, I've created a screening list for unique companies within the Seeking Alpha program with Vuktok analysis. To give an example, there are a lot of great companies in here, all with competitive advantages that I've researched myself, and so I have countless screeners and all sorts of things that I research regularly. And what's interesting about that factor analysis is that it gives a higher score. In this case, for example, for interactive brokers, and interactive brokers might seem a bit on the high side in terms of valuation, but the factor analysis indicates that statistically speaking, this stock has a chance to outperform the S&P 500, so that's quite interesting. Why? Because the valuation seems so high that it's overvalued. Just contradictory thinking. Maybe it seems a bit overvalued. Martins, it's not overvalued because it's going to grow more than people expected. But they could have bought it better now than in a year. But of course, as the valuation rises, the risk is also higher. So here, interestingly, and just for illustration, is interactive brokers. Is this an interesting buy? Yes or no? The honest answer is I don't really know because the valuation has indeed risen to a price to earnings ratio of about 30. Looking at the profitability, then we see excellent figures. Profit margin is okay. It's growing in terms of the 5-year average. The mutual equity is currently also high. So it could also be the case that interactive brokers just has good momentum at the moment. Also regarding cash flow and profitability. I also use interactive brokers myself. I know the company pretty well. They do several other things. But what's striking is that, for example, Morningstar only gives a fair value of $140 for the current price of $220, while analysts think that the stock could still go a bit higher, namely around 7.5%. So there are indeed conflicting factors. Also, if you look at the historical scale, it seems that the huge price spike is leading to an overvaluation of this stock. Look at a more short-term scale. Then it seems to be a bit more manageable, but it's definitely on the higher side. When looking at a few statistics, but let's say that interactive brokers still has a price to earnings ratio of 21 in a few years, because the current price to earnings ratio has increased. It seems with the profit growth that we see below, in terms of estimates, that seems like potential. Not so very favorable, in fact, even a loss. So I don't think this is the best time to buy interactive brokers. We also see that the price has risen significantly since the last buy signal in our happy alerts that we share every week. Check the website for that. We also see that the price has risen by about 150%, so maybe it went a bit too fast in a very short time. But the factor analysis still indicates a strong buy, especially for the momentum. So here's the question. Will the momentum continue to increase? Or has the price risen a bit too much? Anyway, interactive brokers, interesting. Long-term investment. But maybe not at the right price at the moment? Well, to follow and maybe buy us at every larger dip. Alright, these were 5 great companies for long-term inspiration. To make ourselves financially free. Hopefully this works. I always try to meet expectations and provide a lot of value. If you appreciate this and you like our videos, then I'd like you to do me a small favor. Give the video a like and subscribe. Then you'll always get new updates on interesting stocks and investments for financial freedom. But it also helps us grow, and as we grow bigger, we can create more quality and content for you. Here's to financial growth, and thank you for watching.